Hello, I'm Herb Morgan, Senior Managing Director and Chief Investment Officer at Efficient Market Advisors. We are a business of Cantor Fitzgerald Investment Advisors. This is our weekly economic and market. The presentation you're about to see and or hear has been prepared by Efficient Market Advisors for use with investors and financial advisors who are each expected to make their own investment decisions. Nothing contained herein should be treated as investment advice or a recommendation for the purchase or sale of any security. All of the information contained herein is for informational purposes only. A little bit of a rough week in equities last week. The S&P 500 declined 1.35% on escalating fears of a trade war or trade tensions with China. S&P 500 is now down about 2% for the year. The small cap index, the S&P 600, did considerably better. It outperformed the S&P 500 because small companies are seen as less impacted and perhaps even benefited from the trade tensions. International markets, the Asian markets, were closed during our trading market on Friday when a lot of the devastation occurred. Therefore, you didn't see much of an impact there in the EFI index. Fixed income interest rates were slightly higher, therefore bonds were slightly lower as measured by the aggregate bond index and the 20-plus Treasury index. But in a surprise move, high-yield bonds were higher last week. They normally move in sympathy with equity markets that were down. Commodities down slightly, hedge funds up marginally. So, as I mentioned, growing trade tensions between the United States and China. However, I think that's just an easy explanation. The reality is the market had been rising late in 2017 at a very unsustainable rate. It was just straight up, and we were due for a normal and healthy correction. Something had to be the catalyst for that correction, and it certainly wasn't the economic data or the earnings data, so it was this potential for a trade war with China. The S&P 500 decline from its high of January 26 was 10.2%. That's a pretty normal correction. We've now tested it 3 times. President Xi Jinping, though, is expected to deliver a major policy speech in Peru this week at the Asian Davos conference. This week, we could lay out some significant reforms. We also believe that later in the week we have a chance of getting some news about a NAFTA deal being reached between the U.S., Mexico, and China. That could be a positive catalyst for the market as well. Take a look at a chart here, and it shows what I mean about the market being sort of at an unsustainable rate of increase. This sort of run up here is just so steep and so unusual. There was just too much enthusiasm. So it made sense that we get a sell-off. You remember the first sell-off came here. This was on concerns about some inverse VIX volatility ETFs. But you see this big red here down here. This is a relative strength index. When you're in there, it says that the market is technically overbought on a short term and is likely to experience a downward move. It did. Then we got about a little more than a 10% move. We got it here. We tested it again here and here. Obviously, if it breaks through that, we could get to a lower level. But I'm thinking at this point we're probably mostly done with the correction. One of the reasons I think that is because earnings reports are scheduled. We're going to get bank earnings this week, but the first quarter earnings, the major main corporate earnings, are going to start coming out here in about another week, and they're all expected to be very good. A lot of that has to do with growth of the economy, the synchronized global growth that we're experiencing, but also has to do a lot with the tax cut. These are companies that went potentially from a 35% corporate tax rate last year to a 21% corporate tax rate this year. And this chart shows you earnings per share estimates. That's what the EST stands for, Bloomberg estimates. Those earnings estimates have really come up significantly since the passage of the tax cut. We take the fact that the earnings are going up and the price of the market has come down. You see then is the estimated PE ratio that's estimated on 2018 earnings has come down considerably from a very elevated level, down to about 16.7 times. So that makes the market a little bit more fairly valued in here. In terms of economic data last week, the March market PMI rose to 55.6. Now, this is a manufacturing PMI. Manufacturing represents about 15% of the U.S. economy. Been on a nice run. Anything above 50 is expansion. The economy's been on an expansive for several years. In terms of the ISM, which is a competitor or a sister metric, if you will, in the manufacturing, it actually fell a little bit, but it was at a 14-year high in February. You can see that over here. A little bit of a fall, but a very, very high level. It says the economy, the manufacturing economy, expanded in March. It just expanded at a slightly slower pace than it did in February. Construction spending was also reported. This was for February. No change in January, and then up 0.1%. So slowed down a little bit, but is up 3% from a year ago. In terms of motor vehicles, it's been very interesting. When we had the hurricanes, there was a number of motor vehicles that were destroyed in the country. Those had to be replaced. You can see that big bump here was right after the hurricane, and it was expected that that would then, then come down a little bit, get back towards a more normal pace. We're starting to get back towards that more normal pace right now, and you can see that the March sales came in at about 17 million. If you remember the last couple of months of decline, I had said this is nothing to be overly concerned about. Now, services is a bigger portion of the U.S. economy, and according to market in March, that PMI fell from 55.9 down to 54. Still showed pretty significant expansion. In terms of the ISM, probably a little bit more of a followed indicator. The ISM, non-manufacturing or services PMI, fell to again a very high rating of 58.8. New orders were down, but still at a very high level, and employment continues to rise, which is seen as a real positive. Speaking of manufacturing, factory orders for the month of February up 1.2%. That's after a little bit of a decline in January. This series, month to month, is not all that valuable because aircraft are in this series. Aircraft are very big dollar values, and just the timing of the orders can send it all off pretty significantly. Getting into labor, we had obviously we had the weekly initial claims for unemployment report, which came in last week at 242,000. It's a big jump from 218, but 218 is just an incredibly low and unsustainable level number. In fact, 242 is a very low number as well. We don't start to get worried until we see this creeping back up over the 300,000 level, and we haven't been at the 300,000 level now for well over 3 years. In terms of the two jobs reports, ADP, which is a private payroll company, it's actually publicly traded, but a non-governmental entity, they say that according to their statistical models, private payrolls in the United States grew by 241,000 in March, and they revised the February number up from 235 to 246. That's a net gain total, 252,000 on the report. That's a little bit than what the Bureau of Labor Statistics came up with. They came up with payrolls only rising 103,000, but they had a massive gain in February of 326. The revised February and January down. So this was, in a sense, kind of a bad report. It's not unusual to have an occasional bad report. The participation rate dipped down ever so slightly. That seems more like a statistical anomaly to me, but we'll continue to watch it. This also, I think, contributed to some of the market sell-off on Friday. You can see that was a big drop. So we'll watch that again next month and see if there's a rebound. It could be just the fact that that February number was so unusually large. It was sort of a mean version there. So one of the best bits of news we've gotten is that we're seeing average hourly earnings start to increase, and that's been a criticism of the recovery. People talk about the disparity, top and bottom earnings sector of the United States, and hourly earnings tend to lag. First the economies grow, the companies grow, and then slowly but surely the labor market tightens, and then there's pricing power in labor, which can allow hourly earnings to rise. They were up 0.3%. They're now up 2.7% year over year, which is certainly a positive for labor and ultimately for the consumption that labor brings to the table. Another big thing, obviously in the news, I mentioned earlier, the concern that the U.S. has with Chinese trade practices, and I think this is only making things worse. The fact that the trade gap has widened significantly in the last few months. February it grew all the way to $57.6 billion. Goods deficits widened, and we have a surplus in services as part of the trade. That actually fell. So those contributed to a bigger deficit. Deficits subtract from GDP. Obviously, the president, the trade representative, the commerce secretary, and the secretary of state are all focused on reducing the U.S. trade deficit. One of the things about a trade deficit, though, is if you think about it, if we send more money over to China than we get back in goods, that's how you balance it out. It means we're buying an extra $57.6 billion of goods and services, and not just China, but from everywhere. And then these countries have our dollars, and they have to do something with those dollars. The thing they mostly do is they keep them in reserves. The way you keep dollars in reserve is you buy U.S. Treasury securities. And of course, that is needed if the government is going to run a deficit. Based on the new tax law, it's expected, according to the Congressional Budget Office, that the U.S. Treasury will run a deficit for the foreseeable future, and a trade deficit, in a sense, is needed to finance that, or at least keep the financing rates at reasonable levels. Also, consumer credit rose $10 billion in February. January was revised up to about a $14 billion gain, and that is seen as a sign that consumers are confident. Partially that's due, of course, to the wage gains. Winding it up with economic data, nothing today, Monday, but Tuesday we've got small business optimism, producer price index, and inventories. Then CPI, minutes from the Fed meeting come out Wednesday as well. Thursday, jobless claims, import and export prices, and then JOLTS, job openings on Friday, probably come in north of 6.2 million, and then consumer sentiment as well. As always, thanks for tuning in. We'll talk to you again next week.